Most people view the financial markets as a chaotic arena of speculation. They believe wealth creation requires chasing market movements and guessing what happens next. Retail investors often face significant capital impairment when they attempt to navigate these cycles. Trading based on financial press narratives to time the market is statistically a losing proposition. Sustainable wealth building is not a game of predictive gambling. It is a highly disciplined, automated sequence of operations that functions independently of market noise. The first step is defining the gap, the mathematical delta between your total primary inflows and aggregate consumption. This gap is the scalable fuel for your compound engine. You expand it deliberately by maintaining a lean lifestyle or compounding your primary earning power. Before investing that fuel, you must establish an emergency cushion. Accumulating 3 to 6 months of absolute living expenses in a liquid account ring-fences your portfolio. This ensures you never have to liquidate volatile assets to cover costs during an economic downturn. You must also aggressively liquidate high-yield debt. Eradicating a credit card or personal loan with a 12% interest rate is mathematically identical to locking in a guaranteed, risk-free 12% post-tax return on your capital. Achieving this defensive stability is a non-negotiable prerequisite. You cannot deploy capital into active market instruments until your personal infrastructure is bulletproof. Once your defense is set, you can focus on the growth engines. Broad equities act as the central driver of compounding. Buying stock transforms you from a consumer into a fractional owner of an enterprise, allowing you to build wealth through capital appreciation and direct cash distributions. To balance this, you utilize fixed income. These are debt contracts where you lend capital to sovereign governments or corporations in exchange for predictable coupon payments, providing a necessary anchor against market volatility. Rather than selecting individual stocks, pooling resources into mutual funds or ETFs provides instantaneous diversification. While a single company might fail, a broad index mapping the top global giants makes the impact of an isolated default negligible. Passive index strategies are particularly effective because they carry exceptionally low expense ratios. By eliminating active manager bias, these funds statistically outperform the vast majority of professional managers over multi-decade timelines. Utilizing low-cost index funds provides the maximum upside of market exposure while protecting your portfolio from the failure of any single institution. A systematic investment plan, or SIP, automates your discipline. It removes the need to time the market by deploying a fixed sum monthly. When market valuations are elevated, your fixed allocation inherently applies fewer units. Conversely, during corrections, it automatically accumulates more units at a discount. To manage risk, use the 110-age formula. A 25-year-old places an aggressive 85% in equities and 15% in fixed income. This allocation systematically rebalances as you age, smoothly shifting toward fixed income to preserve your generated wealth. This combination of structural automation and mathematical allocation removes human emotion and luck from the wealth generation process. To protect your portfolio over 30 years, you must minimize structural drag. Seemingly minor management fees and transaction costs apply a compounding tax on your final wealth, potentially capturing a massive portion of your total returns. You must also cultivate behavioral neutrality. Market pullbacks of 10 to 20% are standard economic corrections, not emergencies. As noted here, behavioral restraint during these periods is the historical prerequisite for outperformance. Long-term success in the markets is less about superior intellect and more about the discipline to manage fees and maintain composure during inevitable periods of volatility. Early in your wealth journey, your single most potent asset is your human capital, your capacity to generate primary earned income. Automating your investments frees up your energy to maximize this asset. By upgrading technical skills or mastering a specialized vertical, you increase your primary revenue. Scaling your earning power directly expands the gap, providing more raw fuel for your compound engine to process. The financial markets are simply a tool to capture and compound capital autonomously. This system allows you to spend your life focusing on what truly matters, maximizing your human potential.